Hello, my name is Dr. Ola Brown, and I'd like to formally welcome you to the first Healthcap webinar of the year. And today I'll be giving an outlook on venture capital valuations and exit prospects. And I know everybody is super concerned about these topics, so hopefully I'll be able to break it down and give some sense of calm in what seems to be a really unstable market at the moment. Just to introduce myself for people that don't know me, my name is Ola. I started life actually as a medical physician. I'm now a finance professional. I hold a master's in finance. I'm currently about to start my PhD in finance and economics. And I run a company called Healthcap, which invests in terms of venture capital, invests in health tech and fintech. And we also have an infrastructure fund that invests in assets that create a healthier world. So clean energy, healthcare services, and clean water. In terms of our VC, which I'll be speaking about today, we have a portfolio of 30 companies in health tech and fintech. We're currently raising our third fund, which is going to be a $20 million fund, again, focused on early stage health tech and fintech in Africa. So it's nice to be here, nice to connect with all of you, and I hope this information will be useful as you make your investment decisions in the coming year. So I'm going to start by giving a bit of a summary in terms of outlook, setting the context, having a look at 2021, which was quite an extraordinary year, and then 2022, and then looking at the outlook for 2023. So in summary, what do I expect for 2023? We expect VCs to be a bit more conservative with investment. There's a lot of dry powder, but not all dry powder is really dry powder, because we've seen situations where LPs actually don't renege on some of the agreements that they've made with venture capital managers, the GPs, the general partners. So we might see a bit of this year as LPs just decide to allocate their funds elsewhere. And we think that it's going to be a more conservative year. There's more legal regulations, which I'll be explaining a bit more about, that are coming into place. So startups will have to conserve their capital, increase their runway, and also there may be a few M&As, but not the kind of M&As that are these mega exits, but M&As for survival. So I'll be talking a bit about that. So what are the features that we think we'll be seeing in 2023? I think we'll be seeing cost cutting by startups. I think we'll be seeing what I call the private equitalization of VC, which I'll talk about a bit more. I think we'll see increased M&As, but not the massive acquisitions by tech majors, but M&As within, so startups acquiring other startups simply for survival. I think we'll see growth in early stage investing, again in Africa, or at least a flat early stage investing landscape. I think we'll see decline in valuations. I think we'll see more emphasis on corporate governance. I think we'll see stricter regulation in terms of the way venture capital funds are deployed. And I actually think we'll see an increased focus on female founders as well. So how did we get here? 2020 was the beginning, I think, or 2019 probably was the beginning of the VC boom. 2020 was part of that VC boom. And why did venture capital boom in 2020? Well, COVID happened, and that's in big capital letters. That was a black swan that nobody really expected. But that actually encouraged demand for certain tech products. Nobody could go out, so people were video conferencing on Zoom. They were ordering food in from cloud kitchens. There was streaming, if you remember. Netflix stocks went up as people had nothing to do but stream Netflix at home. And home exercise tech, companies like Peloton, for instance, people were riding their Peloton bikes at home because there was nothing else to do. Everybody was bored. We couldn't go out. So COVID really gave sort of, provided the kind of environment for tech stocks to surge and for demand for certain tech products to surge. People were buying all their goods off Amazon because they couldn't get to any shops. So COVID was, really part of the one of the major events that propelled public tech stocks to go up. Also, if you remember, bond yields were appalling. So most of the central banks were trying to encourage people to spend. So some European countries had negative interest rates. Most of them had very, very low interest rates. And when interest rates are low on federal government treasuries in any country, people don't want that asset class. You don't want to put money into treasuries at 1% or 0% or even -1%. So nobody allocates their money at those points in time, or very few people allocate their money, or there's less of a likelihood that people invest in government treasuries. There was also the crypto boom. So people were making money in crypto, and that money, some of that money went into VC. There was the stock market boom with the stock markets and high valuations for publicly listed companies. There was the US government that did this massive fiscal stimulus, right? And everybody got a fiscal stimulus check to spend. So it was really, really encouraging spending. And where were they spending that money? They were spending it on Amazon. They were spending it on their new Peloton bikes. They were spending it on ordering food. So the US government also played a role in the VC tech boom. And then, like I said, the low interest rates made people want to allocate to VC because they obviously couldn't lend money to the government. They didn't want to buy bonds at the time because the yields were low on bonds. There's also an American policy change that made more people be able to enter VC. So there was more VC money around because of that as well. You could raise money and become a GP and raise money from retail investors, and that was very, very exciting and made more money pour into VC. And then there was the rise of the mega funds, Tiger Global, SoftBank, multi-billion-dollar funds, really investing, doing a tech deal every day and investing at incredibly high valuations. So, it was in many ways not an outlier year. I wouldn't call it an outlier year, but I would call it a year in which we saw 2021, the peak of the boom. Funding in startups in 2020 was about 347 billion, and it went to 675 billion in 2021 across 38,000 deals. Large ticket funding for late stage startups, high valuations, increased funding from all the regular LPs kind of drove this. So in 2022, the bubble kind of burst. And even though African startups saw a 50% increase in the total VC funding, most of the world didn't. And this was primarily driven by high interest rates, by increased inflation, by the Russia-Ukraine war, and by startup valuations that were just very, very high. So what we'll see in 2020, or what we think we'll see in 2023 going forward, is increased cost cutting by startups, so lower operational costs, conserving runway. We think we'll see more of a focus on revenue, more of a focus on profit, and more of a focus on margins. We think that we may still see increased early stage funding or flat early stage funding, but at much lower valuations. What I predicted before, which is a rise in survival M&A, so not the massive acquisitions that we see sort of the larger tech players acquiring startups at huge valuations, but rather startups coming together or clubbing together to try and survive. And I just want to talk about some of the factors that really drove that bust and got us to this stage. So I'm coming back to this slide. You see the public markets, there's an irretractable sort of relationship between the public markets and venture capital. And when the public markets nosedive and valuations on the public markets nosedive, then you start seeing kind of like when you're sitting in an economy class seat and the person in the front puts their seat back, then everybody starts putting their seat back. So there are upstream effects into late stage VC funding and then to early stage VC funding, and that's what we definitely saw. When the central bank, particularly the Federal Reserve in the United States, raised their rates to try and combat inflation and try and bring prices under control. You know that sound is coming through on my webinar. When the Federal Reserve in America started raising rates and started to try and combat inflation by raising their rates, then what started happening was that the people that I told you before that didn't want to invest at low interest rates, all the LPs that would normally allocate to VC decided, oh, wow, it's gone up to 2% now, and there's scope for it to go up further. So they started getting excited about bonds again and started reallocating to the federal government treasury bills. And this started happening all over the world. Central banks across the world were raising rates. And of course, that got investors excited. So instead of investing in risky VC, if you could get 4%, which is risk-free from the government, then people started doing that. In addition to that, they started reallocating from the public markets as well, which drove VC down even further. And also there was an energy boom. Remember, the Russia-Ukraine war started and that made oil and gas stocks, energy stocks go up. So people also reallocated their investments into energy stocks and private credit to support energy companies as well. So there was a shift between when before startups were sort of the way to make money and the most attractive asset class. And we found that actually energy stocks became very attractive, as well as the government treasury bills. So that was a big change. We also saw, the vaccine came out. And when COVID vaccine came out, people went back to their restaurants, went back to their jobs, decreased uses of Zoom, started more face-to-face meetings. Peloton, for instance, and companies like it, exercise at home companies, people went back to the gym, and people stopped sitting at home watching Netflix, right, and started interacting with each other like they had. So the demand for those stocks and the demand for those sort of tech products that really, really boomed during COVID actually went down as well. So there was a decrease from the funding side and also a decrease from the demand side. And don't forget that when the Federal Reserve or when central banks raise rates, something else happens. Actually, normal companies find it hard to raise capital. This is called crowding out. So the crowding out phenomenon is when the federal government raises rates and everybody wants to invest in a risk-free rate and people aren't lending to the real economy anymore. So you find that the private sector is being crowded out in terms of credit. And because of that, they end up having to sack people, and those people maybe can't watch Netflix as much and can't pay for data as much and can't pay for the tech products as much and can't shop on Amazon as much. And it becomes a vicious cycle, basically, where companies starved of credit start laying off staff and unemployment rises, which you've seen, and that contributes to the vicious cycle that we're in now with what I call the VC bust. So there were also legal considerations where there are new regulations actually being established by the securities regulator in America, which will increase the level of accountability for venture capital firms and actually allow the limited partners that fund venture capital firms to sue for reckless investments. And even mega firms, one of Sequoia Capital, for instance, is one of the biggest venture capital firms in the world, and they've had to cut their management fee to attract more funding. So the management fee is the fee that a venture capital firm takes for finding all the investments, basically, and managing all the investments, and even they had to cut their management fee. And if you think about what's happened with FTX, for example, where a lot of people, ordinary citizens, as well as venture capital firms, lost money. Most people feel more sorry for the ordinary citizens that lost money rather than the venture capital firms that continue to fund a $32 billion company with no HR department and no accounting department and no board and absolutely no accountability to anybody. And I think that this really shone a light on, you know, a degree of recklessness in the venture capital industry, and, you know, a bubble that had perhaps developed through 2019 to 2021, and was beginning to look irresponsible, to be perfectly honest. So, what's going to happen in 2023? What I personally think is going to happen is, since World War II, most recessions have averaged about 8 to 10 months. And I think that that's what we're looking at here. There's no real consensus on how long the recession will last. But I think if we do go into a recession, the traditional definition of a recession is 2 successive quarters of negative growth. But people also look at things like unemployment and decreased consumer demand as well. But I see this lasting about 8 to 10 months in the best case scenario. In a slightly worse case scenario, or slightly worse scenario, would be over a year or 2 years. And nobody really expects sort of a Great Depression scenario where we have a prolonged recession of 3 years or more. What I think is the most likely thing is we'll have 8 to 10 months of that. And if that's the case, then it's the best time to invest, because there's low liquidity. People are not looking at investments right now, or not as many people as the 2019, 2020, and 2021 era are looking at investments. Valuations are lower. You know, the tourist investors and the tourist founders are kind of out of the market, and we have really serious founders now focused on fundamentals, and we also have really serious investors who are better collaborators and have a more collaborative approach to venture capital. What are we looking at as a fund? We're definitely looking at fintech. That's our speciality. We're looking at e-commerce because, again, that fits into our fintech thesis, and software as a service. For health tech, we're looking at as well. And this is a great example of a software service that, even in this sort of VC winter, was still sold and for almost $1 billion, a Tunisian startup. So what should founders be thinking about as we go into this recession and hopefully come out in 8 to 10 months? Focus on building value, implementing strong corporate governance and transparency ahead of funding rounds. It's going to be more difficult to close these rounds. So make sure that you have extra fuel in the tank, make sure you're extending your runway, make sure you're managing costs as efficiently as possible. There's a lot more focus on unit economics and margins and revenue and the path, a clear path to profitability. So make sure that you're articulating that when you speak to venture capital firms. Corporate governance, you know, being transparent, I think is really important. Reporting habits are really important because subsequent investors talk to your current investors, and you want to make sure that your current investors say, you know, positive things and say that they've been hearing from you, and that you've been transparent in your reporting. I think getting accounting right is really important as well. So making sure that you have a strong CFO or a strong financial controller who makes your accounts transparent, because I think it's a time when there will be more due diligence done on your company. So making sure you're getting your accounting right, making sure that you're getting your audits right. But all in all, this is a great time to build. I mean, some of the greatest startups in the world were born in were started or sort of began in economic downturns. And I think that these companies just have better financial discipline and therefore get better upsides when there are acquisition opportunities. I really think that this is also a time more associated with merit. So I think during boom periods, there's a lot of blurring of the lines between what's a good, strong startup with strong fundamentals and what's an extremely bad bet. People just sort of lose their sense of discretion, and there's this just rush for deals. But I think that during economic downturns, female-founded or female-led startups will actually benefit because when there are more objective criteria for looking at startups, then of course the investment decisions become more based on merit and less based on hype. I think another tip that I'll give to founders is commence funding rounds early. So commence earlier than when you need it, even if it's just the initial networking to get to the round. So I'll just say a bit about our Catalyst Fund as well, because this is open to retail investors. And basically, we are still on the thesis of the main fund, so still a thesis of fintech and Healthtech throughout Africa. We invest across every country in Africa, but only in these two spaces. We have a portfolio here of companies both in fintech and Healthtech. And we're supported by portfolio managers that have assessed more than 350 VC deals. So if you're interested in learning about angel investment and VC, then you should definitely join our membership. So I hope this has been a whistle-stop tour through the boom period and where we are now and where we think we're going to be through 2023. And I hope, despite a lot of the dull news about layoffs and people becoming unemployed and economic recession and all the sadness and misery associated with that, which I know is incredibly painful, particularly for the individuals involved and families, I still want to encourage founders that it's a great time to build a business. If you're in the fintech or health tech space, then please reach out to us. Thank you very much.